Everybody, and welcome to 2013. Today is Friday, January 4th. I'm Andrew Packer, the financial editor at Newsmax, welcoming all of you to our monthly financial brain trust call. Please remember these calls are being recorded, so those who are not participating in this month's call or not speaking should put their phones on mute to minimize background noise. On our conference call line, that can be done by hitting *6. As always, please speak clearly and say your name when you first start speaking. Our topic this month is the bond market, specifically U.S. Treasuries. Now, I kind of ran some of the numbers, and since interest rates hit a kind of peak in 1980, they've been on a long decline, leading in turn to a huge, multi-decade rally in bonds. What's interesting if you go through it is that in the 1980s, Treasury bonds rallied on average about 12.6% per year. In the 1990s, they still did about 8.8% per year on average. Throughout the 2000s, 7.7% per year. And now, so far, we're just in this short decade, so far about 20% per year. So the big question on many people's minds is, will this rally enter into an astonishing 33rd year in 2013, or will we finally go bust? And there's certainly a lot of reasons to agree with on either side of that argument. So this month, it's my pleasure to introduce Steve Cortez of Veracruz LLC, a research firm for institutional trading desks that offers services such as daily rankings of the relative strengths and weaknesses in equity sectors. Cortez is also the author of Against the Herd, a book on contrarian investment strategies. I talked with Steve a little bit, and it sounds like he actually expects, kind of against a lot of conventional wisdom, for the rally to continue. So at this time, I'll turn things over to you, Steve, so that you can explain that in more detail.
You bet. Thanks, Andrew, and thanks for having me on the call. And I am typically contrarian. I wrote a book about it, and it tends to be the way that I approach the markets and the way that I trade the markets and actually risk my own capital in the markets. And I'm certainly contrarian on this topic. The street is almost unanimous. When I say the street, I mean Wall Street, is almost unanimous right now in its outlook for 2013 that the end of the bond rally is at hand. I would also caution that I started trading in 1994 as a bond broker when I got out of college, and that was actually a very bad year for bonds, which is rare. There have been in my career the last 18 years really only 2 years where yields went substantially higher on Treasuries, 94 and 1999. But even though there's really only 2 bad years out of the 18 that I've been trading bonds, I think 18 out of the 18 years, the forecast for the year has been a dramatic rise in interest rates. So perennially, we get from Wall Street a consensus view that interest rates must rise, and almost all the time that view has been wrong. I believe it's going to be wrong again this year, even though yields are incredibly low. And I know particularly to the lay investor, when they look at a 10-year note, which is yielding below 2%, and for most of this year, well below 2%. We're as of today, we're at 1.92, so we're actually getting at least closer to 2%. But they look at that yield and say, "Gosh, that's just nothing for my money," and literally nothing, perhaps, depending on your view of inflation and where inflation, truly should be measured right now. It literally may be nothing for your money. You might say, "Well, there's no way that capital is going to continue to invest there. I'm not going to put my money there. I can't imagine institutions doing so." I, however, take the other side of that argument. I think that rates, while I don't think that yields are going to go dramatically lower, I don't see huge price increases for bonds from here, but I certainly do not see at all a major price decrease. And there are 3 main reasons that I see. And the first one is global overcapacity. When we look at capacity utilization, for instance, which I think is the most important barometer to look at global capacity in terms of production, particularly of physical goods. We look at capital utilization. While it has rebounded dramatically off of the crisis lows, off of the worst levels that we saw in 2008 and into 2009, we're still nowhere near the levels where we were pre-crisis. We're not even close to the levels of the 90s, where capacity utilization would often get into the 90s and certainly trade north of 80. So yes, we've rebounded well off lows, but we are still stagnating at a lower high if you look at a chart of capacity utilization. I think the main reason that the world has so much overcapacity, by the way, is China. So I think one of the reasons that, and for instance, we talk a lot about China owning our debt. One of the reasons that China keeps piling into our debt is I think China knows better than anyone how much overcapacity there is in China in terms of steel production, cement production. The state central planning model of China, which is all about growth at any cost and not necessarily at the at the goal of profits, but rather of political expediency, has produced an overcapacity in China, and particularly in some of those key industries, things like steel, that is so mammoth that it would take global growth of a massive capacity, of a massive clip, to, in any sense, take up the slack of that overcapacity. And we just haven't come close to that kind of growth. We have Europe, in fact, in recession. We have the United States barely growing. And so to me, that is not the recipe at all for a situation where capacity utilization rises dramatically. So given that scenario, I do not believe that on a global level there is serious inflationary pressures extant. And as evidence of that, by the way, I mean, don't take my word for it. I think look at industrial metals, look at precious metals, which gold has had an amazing run as well now for years, just as bonds have. But lately, in the last few months, gold is really starting to sputter. And it's sputtering even though the Fed, in a very ill-advised policy, even though the Fed is embarking on QE3, QE4, the response from gold, where we would typically say, well, gold should fly on that kind of news. September 13th was when the Fed announced QE3. Gold actually is dramatically lower since then. Just a few weeks ago, we got the news of QE4. Gold dramatically lower since then. So I think the metals markets are, I think, evidencing what I'm talking about, which is overcapacity, which means that producers of goods simply do not have serious pricing power because there is so much overcapacity. And in fact, I think the opposite, that we're seeing that because of the recession in Europe, the Chinese are significantly cutting prices on the goods they produce. So all of this, I think, is the background for a world that does not right now have inflationary pressures. And then the second reason that I think the bond rally continues is more domestically oriented to the United States, and that is, and while it is a global phenomenon, I'm more concerned with the U.S. on this issue, and that is wages. Real wages are declining, and wages are in a demonstrable downtrend. That is simply not the recipe, again, for inflation. The last time the United States had serious inflation was in the 1970s and into the early 1980s. We had two phenomena going on then. We had fast rising wages. It was the era of wage controls from the Nixon administration. We also had quickly advancing property prices. To me, that is the real recipe for inflation. Rising wages, primarily, secondarily, rising real estate. Right now we have falling wages. We have a job market that is extremely tough, and particularly for the uneducated, for the lower income earners and for uneducated workers. This is an incredibly dire job market, really, for that segment, for youth. All of that tells me that pricing pressure, even here domestically in the United States, is going to continue to be muted. And I think that part of this is because of government policy, ill-advised policy from both the Fed and on the fiscal side. So on the fiscal side, we have high taxation, incredibly high regulations, an anti-business environment in Washington, D.C. On the monetary side, we have a Fed that is bent on central planning. That combination, I think, leads to, it almost guarantees for the United States low growth or no growth and low inflation. I think it is a muddle-through scenario at best for the United States, and I think we're seeing that in the job market, and we're certainly seeing it in terms of wages. So those who do have jobs are not seeing their wages rise, and far too many people are structurally unemployed. And given that, I think that the pressure on wages is going to continue to support very, very low interest rates, and is going to continue to support the bond market. And then my third reason is that treasuries are still the flight to safety vehicle. And now lots of people argue that they shouldn't be, but the fact is, and this really isn't, can't be disputed, at least in recent years, it has continued to serve as the flight to safety vehicle. Anytime global markets get skittish, anytime there is serious calamity in the world, global capital still runs for the safety of the United States Treasury. So it is still the safe harbor. Many people will argue, for instance, for gold, which I believe is a very false safe harbor. And if we look, for instance, in the financial crisis, at the worst point of the financial crisis in 2008 in October, gold fell more than 20% at one point in October, just when people who thought that gold was insurance, just when they needed it the very most, gold disappointed them the worst at that time. I think the reality is there really is no other true safety vehicle in financial markets other than the United States Treasury. Now, people could argue with me that will change in the future, and it may. I don't believe it will, but I don't think you can even argue as far as the history of how it has functioned. And so given that, international money continues to flood into treasuries, whether it's petrodollars from the Middle East, the Japanese, and by the way, we talk a lot about China owning so much of our treasuries. The Japanese now, and it depends almost week to week, but the Japanese are neck and neck with China in a race to see who holds more U.S. treasuries. So it's not just China. The Japanese are absolutely piling money into the U.S. Treasury market as well. So international demand, I think, will remain incredibly strong. And if you are at all skeptical of the global economy, and I'm quite skeptical of the global economy, I know the stock market has had a heck of a run, I think based primarily on Fed policy rather than the reality of the economy. I think the underlying global economy shows many signs of weakness. I think international trade is in a lot of danger. Europe, I still believe, is, as I mentioned, is in a recession, and one that I think will worsen. All of these factors, I think, point to a need for safety. And the ultimate safety vehicle still, for all of its flaws, and listen, I'm not going to be one who will remotely defend the kind of debt that the U.S. government is putting all of us in. It's irresponsible. It's bad economic policy. It is slowing our growth significantly. But I will also stipulate that the federal government is not in danger anytime soon of having to face far higher interest rates in the United States. So I believe that low growth, low inflation, muddle-through scenario will continue to dominate in the coming years, and certainly for this year. And for that reason, I think rates stay low.
All right. Thanks, Steve, for sharing your views on the bond market. I still think that, even with a lot of those data points, which a lot of our other Brain Trust members have mentioned at various times, there is still this kind of consensus among our group that bonds are more so in a bubble than really most of the other asset classes out there today. I know that that's a theme that Bob Wiedemer has been working on for the upcoming issue of Financial Intelligence Report, so I wanted to go to Bob now for his views. Bob?
Yes, sure. Thanks, Andrew. Yeah, I think, as you said, we all know we're in a bond bubble to some degree, but that doesn't mean it's going to burst immediately, and I think that's to a degree where I would agree with Steve. I think that for a number of reasons he said, and maybe for one other very important one, I don't think we're going to see a huge burst this year. That when we have any kind of downturn, if risky assets are in trouble, people will move into bonds, whether they're foreign or domestic. They will tend to move into bonds. So I think that's people aren't just looking for yield; they're looking for safety, and I think that's one reason that they'll stay up for a while. I'd say more importantly, Steve didn't mention this bond market, I guess indirectly, but this bond market is highly manipulated. This is a bond market that is very, very much controlled by the Federal Reserve. That manipulates interest rates down all the time, and needs to for reasons of the government, for reasons of keeping the economy in better shape, and the stock market up as best it can. It will continue to try and manipulate rates down. And so I guess we're left with the question longer term, where I would disagree with Steve, is does this affect longer term interest rates? The Fed trying to keep interest rates down now, printing a lot of money to do so. And I say it does, because I don't think that overcapacity or undercapacity is what's going to in any way control interest rates. Great example. In the U.S., 1977, 78, 80, 79, 80, we had some of the highest interest rates we've had in 30, 40 years, yet we had tremendous overcapacity. Our Midwestern states were all running at double-digit unemployment, overcapacity in almost all our industries. The auto, certainly, steel, very, very high. Yeah, we had very high inflation, because inflation is really not a factor or a result of undercapacity, overcapacity. It's a result of monetary policy. Basically overcapacity, overprinting, let's say, of too much money. And I think that will ultimately drive interest rates up. And overcapacity, undercapacity will not be relevant. It's just how much money you print, as 1979, 1980 shows. We can have a lot of inflation without it. Now, I don't think we'll have it this year. So that's right. I agree with Steve. I don't think you're going to see that much this year. I think what's going to drive bonds is those two issues of the Fed manipulating the market to keep rates low, and second, I agree, there where people will go for safety. Now, that said, I think there's room for a surprise. And let's keep in mind, if rates this low, and it's one thing to go up 1%, as we all know, when interest rates are at 5%, but if interest rates went up 0.5% or 1% now, when interest rates are below 2%, or even close to 1.5, that's pretty devastating. And that's what's going to be interesting is just, if we do even get small movements, that's what I'm looking at this year, is to see what the reaction is going to be. Because even small upward movements could scare some people. I was talking to a friend of mine at Morgan Stanley, says, what are my clients going to do if they look at their bond funds, and we all know so many people now have bonds and bond funds, what are they going to do if they see those funds, which are theoretically completely safe, going down even 10 to 15%, which, could happen even with a 0.5% or more rise. I don't know if we'll see that much, but again, I'm going to be looking closely to see what happens even with small rate increases, or as the Fed goes through on their recent commitment to try to pull off of QE, which if they do, clearly we'll see interest rates rise. I think they'll pull back from it. I think the downsides are pretty significant. But that's how I'd look at the short term and the long term. I think the short term we'll see. I think Steve may be right. Long term, I think we got some much bigger issues, clearly.
Well, and Bob, it's Steve again. I do think you make an interesting point there, particularly talk about the Morgan Stanley and in terms of private client and retail broker in the world of individual investors. Believe me, I don't think that bonds in general, in the generic sense, are without risk. As a matter of fact, I think that there is unbelievable risk in non-treasury bonds. And because of the reach for yield, because so many investors have looked at the treasury and said, I am not investing in for 10 years and accepting 1.8% or 1.9%, but they still want safety because the individual investor has en masse been leaving the stock market ever since the crisis and has really missed the rally in stocks and continues to just pile money into bonds. But I think far too many of them have gone into less creditworthy bonds, particularly high yield, and have been duped, I think, to a large extent because it has been such a strong market for years that there is safety in those bonds. So I do believe there's a bond bubble. I don't believe it's in treasuries. I think the real bond bubble exists in high yield. I can't tell you how many individual investors I talk to now who, particularly because of the ETF products created here, things like the HYG, which is very liquid, very widely traded, are absolutely piling into these funds. And while they are at multi-year highs or all-time highs, depending on which one you're looking at, I think there's a tremendous amount of danger in high yield. I think that if the global economy is at all at risk, and I certainly think it is, if it is, then high yield, which is far more stock market correlated than treasuries, which tend to be somewhat inversely correlated, at least at times of duress. High yield, I believe, is a place where there's a lot of danger and risk, and I would also add the municipal bond market. Meredith Whitney, I guess now it was about 2 years ago, put out a report, or maybe a year and a half, on the risks to municipal bonds, and she was widely derided for that view, and has honestly so far been wrong. Municipal bonds have continued to trade very well, again, as people are just thirsting for yield and going to any bonds that seem safe. But I do think that ultimately her predictions and her analysis will prove correct. Municipal bonds, particularly in states that have been irresponsible, like my home state of Illinois, California, places like that, that are in dire fiscal situations, I think municipal bonds are greatly at risk. So I think bonds in general, there are bond bubbles, and I think there's going to be a heck of a lot of bond pain, perhaps this year, and if not this year, then soon in coming years. I'm of the belief that it's not going to be in treasuries.
No, I think it's a great point. That if the pain comes early, I think junk bonds is very likely. I think just refis and originations were about $400 billion this year, up from around $150, $160 billion last year. And when I mean last year, I mean 2011. So yeah, people have been buying them like crazy, as you said, in search of yields. I think you're absolutely right. I still think there's a longer-term bubble in treasuries, but it will hit earlier, and the junk bond thing is a really good point to point out just how far that market, I think, is going off the mark.
Mm-hmm.
All right. So I guess Steve or Bob, whichever of you wants to start, based on, this kind of view of the bond market, what would you be looking to invest in over the next year and a half?
Yeah. Well, Steve, if I can start.
Sure.
I would tell you that I'm more adamant about what I would avoid than what I would invest in. I think that safety is king right now, and so I would absolutely avoid junk bonds, high-yield bonds, as we mentioned. I would avoid municipals. In terms of bond, and I'll talk about bond investing first and then move on to stocks, but in terms of bond investing, I would avoid municipals in the profligate states, which are primarily the coasts and then Illinois. I would focus on, I do love municipal bonds as an asset class, particularly for wealthier individuals and particularly for older folks, but I think you really need to focus on states and cities that have responsible fiscal situations, which generally is the middle of the country and energy-producing states, so the Dakotas, Texas, places like that. So in the bond world, I continue to think that investment-grade companies, which are now pretty accessible, again, because of the growth of ETFs, and so like the LQD is a vehicle that I trade and invest in a lot. That is investment-grade corporate bonds of very boring companies, utilities, telecom companies, folks that have paid dividends for a heck of a long time. It's a place to get more yield than treasuries, but I still think get close to the safety that I perceive still to exist in treasuries. So I think in terms of bond investing, look to quality municipals and then look to investment-grade corporates and avoid, or for traders, even bet against high-yield bonds, which is something that I have done and will continue to do, which frankly hasn't worked yet, but I believe will work in a major way in coming months and years. And then on the stock side, I continue to believe that because treasuries offer such a low yield, and I think will continue to for some time, I continue to really like dividend-paying stocks and dependable dividends too. And when I say dependable, I mean a long track record of paying significant dividends. And really the two areas that meet that criteria that I love are tobacco and utilities. So Altria MO is a stock that I own and believe in. It pays right now a dividend yield of 3 times that of the U.S. Treasury. Now, it's not without risk, of course, because you have the price risk of the stock. So I do believe at times, I'll hear the financial media, and sometimes on my station at CNBC, I'll hear people pushing dividend yields as if that yield is free, as if there's a return of capital the way there is in a safe bond. And of course, that's not the case. I mean, it is still riskier, but I do think a 5% cushion in something like tobacco is a very reasonable and intelligent risk-reward ratio that I think makes sense. I also love utilities, and utilities have really been hit fairly hard lately, mainly because of, in recent weeks, mainly because of fears over the change in taxation in Washington. So they've really had a bad 4 or 5 months here, and I think that utilities, I love 2 things about utilities. I love, number one, that they are very domestic, just by definition, right? The United States really doesn't export energy, and because of that, I think utilities are, because I'm so skeptical of the global economy, I think Europe is in such dire shape. I think China is equally perilous. And given my dour international view, I really think the United States, while I don't think the United States is in great shape, I think it's in better shape than China and emerging markets and than Europe. That is, to me, then an attractive asset class looking at utilities. And the second being, again, as I mentioned with tobacco, very significant dividend payments and dividends that I think are largely predictable and stable. Not incredibly economically sensitive utilities, to some degree, do wax and wane with the economy, but there is a certain floor of power and energy usage that exists no matter what the economy is doing. And so even if you're economically bearish, which I generally am, I'm skeptical of the economy, and particularly given what has happened in Washington, what I think will continue to happen, I think utilities are a place to find some relative safety. One thing I would point out, if you believe in interest rates rising, which again I don't, but if you do think that Treasury yields are going to rise, I think the area that will be most susceptible by far and very vulnerable then would be housing. Housing stocks have had just an unbelievable rally. They were the far and away leaders of 2012. They continue to trade extremely well at multi-year highs. XHB is the ETF for that sector that I watch and trade most often. It has largely rallied because of continued low interest rates, on the idea that the housing market will continue to recover because of low interest rates. If you believe interest rates are going to rise, then I think that housing rally in terms of housing stocks, whether it's the actual home builders or related stocks like Home Depot, things like that, to me, housing, if rates rise demonstrably, if I'm wrong about interest rates, then I think the housing sector is a place that can get absolutely slammed because they've had an incredible run. And to me, they're incredibly rich and vulnerable, and it wouldn't take much of a rise in interest rates. I think if for instance, if the 10-year yield were to go significantly above 2% and stay there for a period of time, a period of weeks and months, then I think you could see a serious violent backup in housing-related stocks.
All right, thanks, Steve. Bob, your investment idea?
Sure. I'll begin in agreement with Steve there, in that I look a little bit more to what I'm going to be careful of, and I think he's correct on a number of the bond issues, municipals that are not in good places. My concern, though, I guess, would still be I'm a little bit worried about the long bonds, and even if they are municipal, certainly 20-year, even 10-year, I still am a bit concerned about in this environment. I don't think your losses are real big, but I don't think your upside is great. As I guess the risk-reward ratio is a little scary to me as we start heading into that 10, 20-year bonds, even for some municipals in better states. And I would certainly agree that the worst states are, the Illinois, California would bother me more. I actually think TIPS might have a decent year as well. That'd be something I would certainly be looking at. Certainly we are alike is the TIPS. I think you'll see a nice play there. Not something where we're going to make a ton of money, but I certainly think we'll see something there as well. My concern on stocks, so I guess in bonds, I would say if there's any other areas, I think again more to stay away from. And I'd have to keep it shorter term, and I would emphasize I go with treasuries too. I'm going to stay away from most of the certainly junk and most corporate to heavily stick with treasuries, and that includes TIPS. So I like that in general from the risk standpoint. Stocks. I guess my concern there is that global economy. Just what Steve is worried about is, unlike sort of Main Street American business, small business, medium-sized business, the large corporations that make up the stock market are very internationally exposed. And I think we'll be exposed to increasingly difficult, or at least as difficult, set of economic conditions in Europe and Japan, as we've seen before. And I don't think China's rebound is quite as strong as they're saying, because I just don't see the countries that really work with China, depend on China, export to China, doing quite as well as if China was really running that 8% growth or 7.5% growth they think they are or will run. So I think that all that's going to be headwinds for the stock market, and that is going to affect high dividend stocks, which traditionally I have liked a lot too. But we didn't have a real great year the last year. Partly that was right because of the fiscal cliff issues. So I'm concerned in general about those stocks, but here I'll agree. I'll say that if it is, if something I do like are utilities. They don't have that overseas exposure. I'm repeating all what Steve says, but I'm very much in agreement. We've held utility stocks for a while. They did great year before last, 2011, but 2012 was not a great year. To hold, but I think next year, I think could be okay. If you're going to hold stocks, it's a nice area. You can always look like an ETF like ULX or anything like that, which has a broader range of utilities if you're, just want general exposure to that segment. So I think those are the areas that I look in. Gold has been hammered, and it'll be interesting to see what it does here. I think it'll be up. Although Steve points out how badly gold's been beat, it still closed up about the same as the S&P. We're up about 7% last year. So absolutely, it did not respond to QE3 as we had expected, or as I think the world had expected, or did it respond to whatever we want to call it, QE 3.5 in December, or QE4? Steve was absolutely right on that, but it still closed up fairly nicely, and my expectation that it will close up next year as well. So I still think that's an area to be involved in, but 10% as we got in 2011 or so, probably not. But maybe, we'll see. We got 7 in 2012. I still think we could get a decent gain in 2013. So those are some of the areas I'm looking at, Andrew.
All right. Thanks, Bob. I do have a quick question for both of you before I open things up for our other Brain Trust members. And that question is, what about the foreign bond market, since we've kind of gone through all of the various, U.S. domestic bond markets? Steve, would you like to start?
Sure. Because I'm so skeptical of the global economy and particularly relative value compared to the United States, I do still believe the United States, while not strong, is far stronger than the rest of the world. And because of that, I really have an equal view on foreign bond markets. And I don't focus a whole lot on Japan's bond market, and China really doesn't have one, at least that's investable for us. So for me, that really means Europe are the bond markets that that I watch. And they've had an amazing year, particularly Italy and Spain, as they've rallied massively off the lows, as we've seen the ECB, the European Central Bank, embark on multiple programs of support for those bond markets, and is largely replicating what the Fed is doing here, is happening over in Europe in terms of monetizing their debt and buying their own bond markets. But while I believe that the U.S. Bond market, Treasury market, is going to stay well supported, I do not believe that is the case for Europe, because unlike the United States, Europe, as much as they try economically to be, is still not a country. It is still not unified in so many ways, fiscally, culturally, historically. And given that, I don't believe that the willingness of the taxpayers, particularly in Germany, to continue to support the profligate states on the periphery is endless. And so if that is the case, then the bond rally, and it has been a massive rally in recent weeks and months in Italy and Spain, I think is very much at risk. And if that's the case, I think rates need to rise dramatically for probably most of Europe, but certainly for those periphery countries. And we'll see. I think that the key thing for investors to watch, the easy way for, most individual investors don't really watch Italian or Spanish bonds, but it's just watch the euro currency. And the euro currency, to me, is very vulnerable. If I'm right about Europe, then I think the euro currency needs to trade dramatically lower. The euro currency has been pretty boring, honestly, for the last few months. We've really just kind of traded both sides of this roughly 1.30 level versus the dollar, and spent a good part, for that matter, of 2012 around that level, but certainly the last 4 months. If your currency starts to break significantly, starts to break down to 1.25 versus the dollar, that kind of area, then I think that will be the warning sign that we're going to see a significant rise in rates in Europe. So I would certainly caution investors as well to not, in terms of the reach for yield, which I think has gotten dangerous because of low Treasury yields. I think people have piled into areas that are dangerous, seeking yield, like junk bonds, for instance, which I mentioned before. I think we've seen a little bit of that, not a ton, but a little bit of that into international bonds from sort of mom and pop investors, and I would really caution them that I think emerging market bonds, European bonds, offer yes, significant yield, but for a very good reason, and that is that I think they're very risky.
Yeah, I would say they're risky as well. I'm not a big fan of the international bonds. I guess two additional comments I would make to what Steve said that I think are important is the one, I guess, upside is, well, like the U.S., they're becoming a more manipulated market. The ECB has, said and is making sure that those Spanish and Italian bonds don't have huge problems. So there may be some play to make there, kind of what you might call a manipulation play, but that's not, for your average investor, and it's hard to predict exactly what's going to happen there. So I tend to stay away from international bonds, even if there are some opportunities due to ECB intervention and manipulation. I guess the other issue is that sometimes people like these because of the dollars falling, the international bonds go up. I don't necessarily see a big fall of the dollar enough to, again, make it worthwhile this year to be involved in international bonds. So, without adding too much more to Steve, just those two issues, I think I would stay away for the most part as well.
All right, thanks, Bob. Now that you've shared your insights, I'd like to open up Q&A for some of our other Brain Trust folks on the call. No need to jump in at once, guys. I know we had Mike Carr on the line. Mike, do you have anything for Steve or Bob on the bond market?
My question would just be, how would all of this impact gold in particular? Should we see interest rates rising too fast?
Well, it's Steve. As I think I mentioned, or at least hinted at, I'm not a fan of gold because I don't see serious inflationary risks. And I think gold's performance, and I don't want to put too much emphasis just on a few months, because gold is not a huge market, and so if there are some very motivated large sellers, that alone can keep gold prices depressed, irrespective of fundamentals, certainly for weeks and months. And I think gold bulls would argue that that's what has occurred in recent months. A lot of hedge funds in particular piled into gold in a major way, John Paulson being certainly the most well-known of that cohort, and I have no idea, but there's a lot of rumors, at least, that he shed a substantial portion of his position in the fourth quarter, and that kind of persistent selling is what has depressed gold rather than the fundamentals. I have no idea if that's true or not, but I still believe that gold's performance relative to Fed policy has to be incredibly disappointing, I think, to gold bulls, because if you were to lay out for me QE3 and then QE4 to come in such quick succession, and with such really just disregard for economic reality, to me at least. I mean, I think it sounds like we're somewhat unanimous, I think, on the call in terms of our disdain for Fed policy. If you were to lay that case out to me ahead of time, I would have guessed significant gold rally. And in fact, we've seen a very significant gold decline since that time. And it tells me two things. Number one, I think the position is far too popular. I think the idea of gold as an investment class has just gotten to be too ubiquitous out there. The constant television commercials, I hear about it from my old retired Catholic school teacher mother, constantly talking about investing in gold. To me, that is evidence of a warning that gold, in fact, may be in somewhat of a bubble status because it's gotten too popular. And secondarily, then I think this is the more important point for me, because that's hard to quantify. Obviously, when has something gotten too crowded or too popular? But what I think I can quantify is the lack of inflationary pressure out there, and I see that not just in gold, but in the other metals, for example. We continue to see a very tepid trade lately in copper, which vastly underperformed the S&P in 2012, and I think will continue to. Just to speak to something Bob mentioned before, if China were truly growing at 8%, I think we would see the copper market on fire. And we see quite the opposite, in fact. So I think, when we look at the reality of prices, of what people are actually willing to pay for these physical goods, they are not at all representative of a China growing at that kind of clip. And I think they're also representative of a lack of inflationary pressure, which I think is a poor environment for gold. One other point I would make, I know consumers are rightly upset that their food and energy costs are out of control in some cases, and largely because of Fed policy. But, for instance, if we look at agricultural markets, just today, the DBA, which is the best, most liquid ETF for agricultural markets, it combines the grains, the meats. The DBA has traded miserably, and relative to the S&P, it's actually hitting a 4-year low as of today. So that is just not indicative at all of inflationary pressure. When I look at the way gold trades, the way copper trades, agricultural commodities, they're all telling me that, if anything, the risk to prices is actually still lower, not higher. So that the Fed has succeeded so far in lifting the prices of stocks, but it has not succeeded in lifting the prices of really much of anything else, at least in recent months. So given all of that, I continue to view gold bearishly. I'm actually short silver right now, which is a trade that so far has worked very well. We'll see. It's very volatile, but it's certainly had a very poor few months, and even in this new year is having a poor couple of days.
This is Jared. Two comments. Firstly, I really disagree that inflation is so low. If you look at shadowstats.com figures on the real rate of inflation as opposed to the phony baloney figures the government uses, they come up with an inflation rate as high as 10% currently, and I see this in everyday life. I mean, I see energy prices going up, healthcare prices going up, school tuition going up, food going up tremendously. So I think the idea that inflation is low is just plain wrong and a reflection of official government statistics. And a reason to think inflation will continue to increase is the enormous monetization of debt occurring now with the the government's purchase of bonds, which is monetizing debt and putting lots of money into the money supply, and their continued statement that they'll buy as many bonds as possible to pump up the economy. So I think the idea that inflation is low is just plain wrong. And the second comment, just real quick, is just a investment recommendation, is Extra Space Storage, EXR. If you look at the chart, in the last year, this is a storage company, the stock is up about nearly 100%, and since mid-2009, it's up sevenfold, and it's just a tremendous, great chart. As people downsize, as the average person continues to struggle, there's just huge demand for storage space. So that's my recommendation, EXR.
Andrew, I'll jump in for a second on the gold issue. What I think is interesting is I agree with Jared that we probably have much higher inflation than CPI is saying, but I think CPI will stay relatively low this year. And it's an interesting point that Steve makes is that low inflation expectations equals lower gold price or not a great ride. But the reality is inflation expectations haven't been that great for at least the last 10 years. At this point, yet gold's up 400% plus. So it hasn't needed in the past, certainly recent past, and that's fairly long recent past, 10 years, a lot of inflationary expectations to drive it. So I guess I'm not as worried about that. What I think bothers me more on gold is the recent response to QE. I think that is something that would concern me a bit, but again, I think that overall, I think there's still some upward pressure on gold. But at any given year, gold can go down. I just think it's a good long term, and I do think this year will be relatively good. You're right. There are some major sellers out there that might be affecting, including sort of the midnight Asian seller that lots of people talk about. But a lot of the down days for gold the last couple of months came from sort of trades in Asia when the European and U.S. markets are closed. So we don't exactly know what's going on there, but either way, it is clearly creating some downward pressure on gold, at least more recently. But I'd also say the one thing I would disagree with you, Steve, is that gold is talked about a lot, but I'm not sure how many mainstream investors are really getting into it. People are buying physical gold, maybe keeping it. Certainly ETF sales are definitely up. There's no question those demands have been up and really weren't affected as bad more by the recent downturn. I think it really has not become a mainstream investment. If you go to your typical Merrill Lynch or Morgan Stanley broker, they're generally not going to put you in 5% or 10% gold. If they're going to put you in gold, they're going to put you in gold mining stocks. So I'm not sure that it is as crowded a trade as you're saying. Certainly there's a lot of discussion. Certainly more people have got involved, but I'm not sure it's as crowded. All that said, again, in any given year, I don't know. But I will say that inflationary expectations are not something that has driven gold as much in the past, certainly on a 400% incredible bull run. I'm not sure that's what's going to drive it this year. So again, I'm reasonably confident this year. I'm certainly confident longer term that gold will continue to do well. But that would be my comment. So, Andrew?
Yeah. Bob, it's Stephen. You certainly make a great point about gold miners, and I think that is, although I'm skeptical on gold in its entirety, I'm far more skeptical of the miners, and the miners have significantly underperformed physical gold. Yep. For several years now. And so, I would concur that in terms of retail investors and where they have gotten too extended on the gold theme, I think it's primarily the miners. But I guess a question for you, if you believe in inflation, to me, rather than gold, it seems to me that the most reasonable investment would be property, would be land, because it has all of the characteristics of gold in terms of finite supply, can't be created or destroyed. And in an inflationary environment, land tends to do incredibly well. And unlike gold, which has had a great run, land on the whole is still, far off where it was in 2007. I mean, it depends where you're talking about, of course. But in general, land is at still depressed prices. If you believe in inflation, and on top of all that, unlike gold, which pays you no dividend and no yield, land has at least the potential to pay you a rent, to give you a dividend yield effectively. So if you believe in inflationary pressure, why would you not go for land rather than gold?
And it's a good point, because back in the 70s and 80s, even with inflation, property went up well. And what I would say is I would agree with you, Steve, if property prices were back where they were in the 70s, 80s levels, and interest rates were higher as they were back then. What worries me about land at this point is we're at a far higher price for real estate today than in, say, 1980. And that's so we have what I've said is a real estate bubble, and it's still high, even though we've come back a bit. I think we're still very bubbly compared to that 1980 price. And number two, because of the very low interest rates, if you take those interest rates up from where they are today to 8-9%, let's assume a big jump with inflation, I think that's going to be much more devastating to real estate because of the high prices than, say, it was back in 1980. So it's a combination, both relying on the fact that I think real estate is much more highly priced than it was when we had inflation earlier, and those interest rates are much lower. Obviously, the two are related. But those interest rates go up, I think it's going to hurt a lot more from the interest rate side than it's going to help from the inflation side. I think we got some real issues there. So I would hate to see Florida under a 10% interest rate regime right now and see what happened to Florida, even though the real estate's certainly taken a cut in price. I think 10% would be a devastating blow. Even if there's some inflation on top of that, which there certainly could be, I think overall the real estate's going to suffer a lot.
Yeah,
it's because of its pricing now. And again, people are buying all this real estate at these. I mean, what are we saying? 60-year lows on mortgages.
Well, yeah, for that matter,
we were at 6.75% mortgages for a lot of people in 68, 6.5.
Right. I think 10% mortgages would honestly send the country into an absolutely dire depression. Not just Florida real estate, but so I mean, if you believe in a serious rise in interest rates, I don't think that, to me, and again, that's not my view, but to me, the best play is really not so much betting against bonds. I would actually be betting against stocks, and particularly stocks that are exposed to housing.
Couldn't say you're wrong on that. I think that would be a very good play as well. I would agree. Mm-hmm.
Okay, any other questions for Steve or Bob? Tom Hutchinson, I know you were on the line earlier.
I know you guys don't like international bonds, and you mentioned emerging markets in Europe. Do you have an opinion on maybe Australia and Canada?
Steve, Australia, to me, the problem there, and Australia's had a heck of a rally in really any sense, whether you're looking at the Australian currency, property prices, which are incredibly high still in Australia, certainly their stock market. Australia's done very well. My beef with Australia, though, is that it is still really China's quarry. It is still primarily a supplier of natural resources to China. And given that I'm incredibly skeptical of China, I think that China is in crisis mode, in fact. And I think the Chinese stock market has shown us that. Although it's done very well in recent weeks, it still had another pretty dismal year, particularly compared to global equities. It's certainly compared to the United States. So China continues to drastically, in terms of its equity market, underperform the world, underperform the United States, despite, if you just looked at the financial media, you would think that all is rosy in China. The Chinese investors themselves are not showing us that. And in fact, they are getting their market out of China as fast as they can and buying into U.S. Treasuries, by the way. The Chinese actually love U.S. Treasuries at a 1.9% yield. Now, they may be dead wrong on that, but that's, the reality right now, at least, is that they love Treasuries. So given my views of China, I think Australia is a very dangerous place right now to invest. And also, I would say that domestically within Australia, their housing prices have rallied so hard, and largely because of a lot of Chinese money, by the way, pouring into Australia. But their housing prices have rallied so hard that they now have some house price, some real estate to income ratios that are very comparable to where the United States was in 2006 and 2007. So I think there are a lot of bubble characteristics to Australian housing right now. So Australia, when I do trade it, I tend to view it from the short side. And frankly, it didn't work terribly well in 2012 when I did try to bet against Australia, but I'm still of that mindset and still, looking to do so. I would say some of the same applies to Canada. It is certainly still primarily a resource play, and is certainly very exposed to China as well, although not nearly to the degree that Australia is. But I much prefer Canada, given its obvious proximity to the United States and its closeness with the U.S. market, which, again, I don't think is strong, but I still think is stronger than the rest of the world. But it's interesting, too. It's if you look at there's so much media hype, really, about commodities and commodity countries that you would think all is rosy in Canada. If you look at the Canadian stock market, significantly underperformed the United States in 2012, despite I think sentiment, which is extremely bullish, and certainly media sentiment, that is. The fact is, if you look at Canadian stocks, significantly underperformed in 2012, even worse in 2011. So you've actually been far better off in recent history investing in the United States rather than Canada, and I think that will continue. Although, again, prefer Canada over Australia because of less dependency on China.
Yeah, I would say I agree almost entirely with what Steve just said. So to make my comment short, I'll just add that Australia has had probably the best performing developed economy of any nation, or developed nation economy of any in the world, it's almost like the bond market. It's had pretty much a 30-year run with very few down years. So that, I think, has added a lot of froth to that real estate market. Again, both are really great economies, but again, Steve said China's the issue on Australia especially, and to some degree on Canada. It's got a commodities issue, and of course, its biggest trading partner is the U.S., which is slow, but I think will remain a bit more stable for a little while. But yeah, real estate in Vancouver and Toronto has gone crazy in Canada. So we'll see. But I'll just keep my remarks short and just say pretty similar to what Steve said. Absolutely.
All right. Well, as long as we have Steve on the line, I guess one question I'll have that might be a little more sort of outside just the bond market in general is, what's the one quote unquote unpredictable event that you think is likely to happen in 2013?
Put me on the spot there, huh?
Yeah.
The unpredictable event. I still remain incredibly negative on China in general. Now, I don't know that that's super unpredictable because, again, their market has traded poorly, and I think that skepticism of China is growing. While it's certainly not consensus, though, I think Wall Street consensus is still incredibly bullish long-term on China. The Wall Street consensus, I think, is that there's some near-term problems, but the long-term outlook is terrific. I am very much on the other side of that view. And in terms of the nearer term, though, in terms of this year, what can happen in 2013 in China, I think there are two risks that, to me, are very scary and very few people are really thinking of. The first is an escalation of tension with Japan. I think the situation is very serious on both sides. The Chinese, because growth is slowing, are becoming more nationalistic and have really created a crisis over these islands that are uninhabited and worthless and they really mean nothing except for symbolism. But it is a typical tactic of tyrants, and China is a country run by tyrants. That when there are domestic problems, and I think they have significant domestic problems because of the economic slowdown, to divert attention and to create a nationalist theme, and that has certainly been evident in China, I think, so far. On the Japan side of this tension, we have similar things at work. Granted, it's not from a dictatorship, it's from a duly elected government, but nonetheless, a far more nationalistic government. I think the Japanese people, very understandably tired of 2 decades of economic malaise, particularly older Japanese who remember much better times. I think they are becoming increasingly nationalistic and angst-ridden over the fate of Japan, of a once incredibly proud, prosperous country that is in a seemingly endless decline in every way, demographically, economically, and so it is a very natural human nature response to become bellicose and to become nationalistic, and so we're seeing that on the Japanese side as well. So I think the risks of a conflict there of some type, I don't mean an all-out war, but any kind of shooting of no matter how low level, between the world's second and third biggest economies, I think is a risk that Wall Street's paying very little attention to, but I think is a very real risk and something that absolutely could happen in coming weeks or months. I don't think this is a long term. This could happen in 2 decades out. I mean, I think this is something that absolutely could happen soon, and something that I'm watching very closely. Japanese markets have been incredibly active over the last few months, leading into Abe's win and since, because he has pledged he wants to far surpass even Ben Bernanke in terms of the easiness of monetary policy in Japan, and he promises to produce inflation in Japan. I'm not sure he's going to succeed in that, but so far markets have reacted very strongly, selling the yen dramatically, buying Japanese stocks. Nikkei's had an unbelievable run. It's up almost 20% in the last 2 months. I think all of that could be very much at risk. It would just take a couple of skirmishes in the waters between China and Japan. So, and then the second risk, I think, to China, which is where I tend to see the most risk in general anyway, is its power transition, which, on the surface, of course, has gone fine, the transition to a new leader there and a new government. But I think underneath the surface, there are many signs of trouble, some of which are known, others of which are just rumored. But the transition of power in China, I think, does bring with it many risks, and China is in a really tough spot right now because the government, there's a lot of pressure on the government to ease further to try to stimulate growth because even 8% growth, which I don't believe it's achieving, but even 8% growth is really not fast enough for a country like China to sustain employment, to continue to urbanize at the rate that they have been. So there's tremendous pressure for them to ease more, but at the same time, easing more risks a serious inflationary domestic spiral there, which is very dangerous, particularly for their very low-paid workers who just simply cannot afford any serious increase in their input costs, in food primarily. So I continue to believe that the new government is between a rock and a hard place in China, and that the risks are very real there.
All right. Thank you very much, Steve. We are getting up on the top of the hour. I have time for one more question, I think, if anyone has anything else they'd like to ask today.
Andrew, can I throw one to Steve? On everybody's,
sure.
Not sure to say, but in many people's black swan list last year of events was a problem in Iran, Israeli attack on Iran, or U.S. Joined in, or anything like that. Do you think that likelihood has gone up or down? I know it's not exactly in your bailiwick, but it's kind of along the lines you were just talking about. So what do you think about that going forward?
Sure, Bob. And honestly, I don't follow that nearly as closely as I do Asia. But I will say this. I've been impressed and surprised how strongly crude has remained bid, even while other commodities have not been. And I think one of the reasons, perhaps, is the point you bring up, is this lingering threat of an attack on Iran that is providing a floor to crude oil. And because I believe that the economy is slow enough globally that West Texas crude should not be in the 90s. And yet it's fairly stubbornly staying above $90. I think the reason is that geopolitical risk that is out there now, and I think it was certainly heightened by Obama's win, is my view, because I think that it told the Israelis effectively, you're on your own. And that the United States, I cannot fathom, and this is not my bailiwick, but I cannot fathom the Obama administration supporting an attack on Iran. And so I think telling Israel that you're effectively on your own actually raises the odds then, to me, of such an attack. And, I have no clue. I'm not a military analyst. I don't have a clue if Israel is really capable of pulling it off. If they're really planning it, all that is beyond my capabilities and expertise. But what I do know is that crude has stayed relatively well bid, and my guess is it's going to continue to, and that Iran is putting an effective floor underneath crude prices.
All right. Well, thank you very much. Time to wrap things up. I'd like to thank all of you for joining today and sharing your ideas. As always, if you have any input or heard anything that's worthy of a further discussion, please feel free to send around your thoughts via email. And I will also be sending around email with some of the investment ideas we've discussed today for your thoughts and input and voting. We'll be having our next call on Friday, February 1st, and I will have some more details out to you as that approaches. Thanks for a great call, everyone.
Thank you. Thanks, Andrew.
Bye.